Have you ever looked at a stock price flashing across your screen and wondered what it truly represents? It's a number, one that changes by the second, driven by news, driven by sentiment, and the chaotic dance of buying and selling. But what is the real value of that piece of a company you are considering owning? Is it simply what someone else is willing to pay for it at this exact moment? Or is this something more fundamental, like something anchored and enduring? This question is not just academic, it is the absolute cornerstone of intelligent investing. Answering it separates speculation from investment, guesswork from analysis, and ultimately fleeting luck from sustainable success in the financial markets. The journey to becoming a sophisticated investor begins with a shift in perspective. You must learn to see a stock not as a flickering ticker symbol, but as a fractional ownership stake in a living, breathing business. When you buy a share, you are buying a claim on its future earnings and its future cash flows. The price you see on the market is the collective opinion of millions, but it may or may not reflect the intrinsic value of that underlying business. The art and science of valuation, therefore, is the pursuit of this intrinsic value. It is an attempt to cut through the noise of the market and arrive at a reasoned estimate of what a business is worth based on its ability to generate cash for its owners over the long term. What is the most direct and tangible return an investor receives from owning a stock? While the hope of selling it for a higher price in the future is a powerful motivator, the most concrete reward is the cash dividend that a company pays out to its shareholders. These are real dollars deposited into your account, a portion of the company's profits shared with you, its owner. The core idea behind dividend-based valuation is beautifully simple. The value of a stock today is nothing more than the sum of all the future dividends you expect to receive from it, with each of those future payments adjusted for the time value of money. A dollar received a decade from now is worth less than a dollar in your hand today, so we must discount those future flows back to the present. This concept is often summarized by the old saying, a bird in the hand is worth two in the bush. In investing terms, a dividend paid today is a certain return, a bird in the hand. Future dividends are the birds in the bush. They are expected but not guaranteed. The potential for the stock price to rise is the birds in the bush, expected but not guaranteed. Dividend discount models at their heart are a systematic way of valuing all those birds in the bush by calculating what they are collectively worth in today's dollars. This forces us to think critically about a company's ability to sustain and grow its profits over the long run, as those profits are the ultimate source of all dividends. It shifts our focus from short-term market noise to the long-term health and cash-generating power of the business itself. Imagine you owned a magical apple tree that produced a predictable number of apples each year, forever. How would you determine the tree's worth? You would likely estimate how many apples it will produce each year into the future, and then decide what that stream of future apples is worth to you today. A stock in a stable dividend-paying company is much like that magical tree. The company is the tree, and the dividends are the apples it produces. So, how do we tame the infinite and make the valuation of a perpetual stream of growing dividends manageable? This is the genius of the Gordon growth model, also known as the dividend discount model with constant growth. Instead of forecasting every dividend individually, the model simplifies the problem by assuming dividends grow at a steady constant rate forever. This single assumption condenses an infinite series into a simple formula. It provides a practical tool for estimating intrinsic value, transforming a complex concept into a tangible number. The formula itself is straightforward. Stock value equals D1 divided by the difference between R and G. Let's break this down piece by piece. First, D1 represents the expected dividend per share 1 year from now. This is not D0, that's the dividend that was just paid, but next year's forecast. It forces us to be forward-looking about the company's immediate prospects. Estimating D1 often starts with the most recent dividend and applies an expected short-term growth rate, reflecting management guidance or analysis. Next, R is the required rate of return. It's a personal and critical input. It represents the minimum annual return you demand to compensate for risk. Think about investing in this stock versus something safer, like a government bond. Riskier company, higher R, stable company, lower R. R reflects your opportunity cost and tolerance for risk. Finally, G is the constant growth rate of dividends in perpetuity. This is the model's most powerful and most sensitive assumption. G must be realistic and sustainable. It can't exceed long-term nominal GDP growth forever. Small changes in G can massively affect valuation. Choose a conservative, justifiable G. Together, D1, R, and G form a powerful triumvirate for estimating intrinsic value. Now that we have the formula, how does this work in the real world? Let's move from the abstract to the concrete with a practical example. Imagine we are looking at a large, stable utility company, which we'll call Eversteady Power. These types of companies are often good candidates for the Gordon Growth model because of their predictable earnings and consistent history of paying dividends. Let's say Eversteady Power just paid an annual dividend of $2 per share, which is D0. After analyzing the company and the broader economy, we forecast that the company will be able to grow this dividend by a modest and sustainable 4% per year into the foreseeable future. Our first step is to calculate D1, the expected dividend 1 year from now. This is a simple calculation. We take the most recent dividend, D0, and grow it by our estimated growth rate, or G. So D1 equals $2 times 1 plus 0.04, which equals $2.08. This $2.08 is the numerator in our Gordon Growth Model formula. It represents the first cash flow we expect to receive as a new shareholder. This step, while simple, is crucial because it anchors our entire valuation in the immediate, tangible future, making our forecast just a little bit more concrete and less of a purely academic exercise. Next, we need to determine our required rate of return, R. This is a personal decision based on risk. Given that Eversteady Power is a stable utility in a regulated industry, it's less risky than a small tech startup. A US government bond might be yielding 3%, which we can consider our risk-free rate. For the additional risk of owning Eversteady stock, we might demand an extra 6% return, known as an equity risk premium. Therefore, our required rate of return, R, would be 3% plus 6%, which equals 9%. With all our components in place, we can now plug them into the formula. Stock value equals D1 divided by R minus G. Substituting our numbers, we get stock value equals $2.08 divided by 0.09 minus 0.04. This simplifies to $2.08 divided by 0.05, which gives us an intrinsic value of $41.60 per share. This number is our valuation anchor. If Eversteady Power is currently trading on the market for $35 per share, our model suggests it is undervalued and could be a good investment. If it's trading at $50, the model indicates it is overvalued and we should be cautious. Like any powerful tool, the Gordon Growth Model must be used with a deep understanding of its underlying mechanics and more importantly, its inherent assumptions. What are the foundational beliefs we must accept for this model's output to be meaningful? The most significant and defining assumption is that the company is in a steady state and that its dividends will grow at a constant rate, G, forever. This is a huge simplification of the real world. No company grows at a perfectly fixed rate year after year. This assumption implies that the model is best suited for mature, stable companies that have predictable growth prospects and are past their high growth volatile phase. Another critical assumption is that the growth rate G must be less than the required rate of return R. Look at the formula again. Value equals D1 divided by R minus G. If G were greater than or equal to R, the denominator would become 0 or negative, resulting in a nonsensical stock value, resulting in an infinite stock value, resulting in a negative stock value. Mathematically, this is obvious, but financially, it tells a profound story. It means a company's dividend growth cannot outpace the return that investors demand forever. If it did, investors would be willing to pay an infinite price for the stock, which is impossible. This constraint forces us to be disciplined and choose a perpetual growth rate that is realistic and logically consistent with financial theory. The model also implicitly assumes that the company will continue to exist forever and will continue to pay dividends. For many large established blue chip companies, this might seem like a reasonable bet. However, history is filled with giants that have faltered, been acquired, or gone bankrupt. So armed with this model, can we now value any company on the stock market? The answer is a resounding no. The Gordon growth model is not a universal valuation key. It is a specialized instrument designed for a particular type of company. Knowing when to use it is just as important as knowing how to use it. The model performs best when applied to businesses that closely match its core assumptions: mature, stable companies with a long history of paying dividends. Large utility companies, consumer staples giants, major telecommunication firms, real estate investment trusts, or REITs. These firms' growth has moderated and become more predictable. They've typically moved beyond rapid expansion. They don't reinvest all profits back into explosive growth. Instead, they generate substantial, reliable cash flows and return a significant portion to shareholders as dividends. Conversely, the model is inappropriate for many other companies. Consider a young, high-growth tech company or a biotech firm still in a research. These companies often pay no dividends. Why? They reinvest every dollar of profit and often borrowed capital back into the business. For these firms, D1 is zero, which would make the stock's value zero under the formula. That's clearly wrong. Their value is in future growth potential. Using the Gordon growth model on Amazon or Tesla in their high growth years is futile. It's like using a ruler to measure temperature. As we conclude our journey through the Gordon growth model, it is essential to step back and reflect on the bigger picture. The goal of learning a model like this is not to become a human calculator, blindly plugging numbers into a formula. The true purpose is to become a more sophisticated financial thinker. Understanding the Gordon growth model demystifies one corner of the valuation universe, giving you a tangible method for anchoring your investment decisions in the fundamental cash generating power of a business.